All right, this is the Q-Man. How is everybody? I'm excited for today's podcast. I've been trying to get James Lavish on for a long time, somebody who I really respect and I know can break down the disaster in the global economy in terms that you and I can both understand, which is great because I don't know about you, and I don't want to speak for you. I don't want to insult my listener base again. But I need the remedial explanation of what's going on. And so I know James Lavish is capable of taking jargon and putting it into terms that I can understand. Like reading a beer menu somewhere, like reading a draft list. That's something I'm capable of doing. All right, this podcast, like all my podcasts, brought to you by my patrons, who are people that sign up and donate a monthly recurring sum to help support the podcast. You can check out my Patreon link. It is in the podcast description. And also my subscribers to my near daily Substack, Fringe Finance. You can sign up for free. That link also in the podcast description. This podcast brought to you by my exclusive gold and silver providers over at JM Bullion. I have had a long-time relationship with JM Bullion for good reason. I love buying my gold and silver bullion from them. They turn around my orders quickly. They ship discreetly. Their prices are always reasonable, and they always have great inventory, even when there seems to be a run on physical precious metals. I have noticed that my friends over at JM Bullion don't seem to be out of stock as much as some other bullion dealers during those crucial times. Although I know my listeners are astute enough to be buying gold and silver bullion before the panic so as to capitalize when the shitteth hit the faneth. Folks, JM Bullion has been in business for nearly a decade. They've done over $7 billion in sales, and QTR Podcast listeners have their own rep there. So if you don't want to deal with the website, which is wonderful and easy to use anyways at jmbullion.com, but maybe you have questions about buying gold or silver bullion, you've never done it before, you can email Laura, Laura, at jmbullion.com. The wonderful Laura. Tell her you are a QTR Podcast listener, and she would be happy to help you on a one-on-one basis. So if you're looking for some personalized service, I know if you're going to be shelling out to buy some bullion, you would perhaps like some extra assurances that your order is being carefully minded for. Shoot Laura an email. Tell her the Q-Man sent you, and she'd be happy to help out. So my kind friends over at JM Bullion, longtime supporters of the podcast, just like my brother George Gammon over at Rebel Capitalist Pro, also a longtime supporter of the podcast. Rebel Capitalist Pro, the expertise of George Gammon, Lynn Alden, Chris McIntosh, and they help you understand how to preserve your wealth in a world of out-of-control central banks. Rebel Capitalist Pro offers incredible live question and answer sessions with these experts. You get access to all of their premium research. Lynn Alden, Brent Johnson, whoever you want, it's all available through one service, which that in of itself makes it worth it if you ask me. You get access to the Rebel Capitalist forums where people are talking about macroeconomics and investing ideas on a daily basis. George Gammon's content is incredible. If you're looking to understand central banking and the, Keynesian modern monetary theory model that the world uses, the fractional reserve banking Ponzi scheme, better than I can put into words, for sure. Maybe James Lavish can help with that today. But better than I can put into words, Rebel Capitalist Pro is an incredible resource. Love it. I love reading their forums. George Gammon, another honest person to do business with that I have known for years and can vouch for personally. Link for Rebel Capitalist Pro is in my podcast description. Tell George that the Q-Man sent you and you want a deal. Tell him you want 10% off or tell him you want a month free. I don't know. Just make something up and tell him I said it was okay. He'll be happy to help you out. I might pay for that one. George. I don't think he listens, so I think we're in good shape. All right, this podcast also brought to you by my sole Bitcoin sponsor, my kind friends over at Swan Bitcoin. Swan Bitcoin is an app that helps you stack Satoshis, stack your Bitcoin on a recurring basis. You can set it and forget it like the Ronco Showtime rotisserie grill. Put down as much as you want to invest over as much of a time period as you would like, and the app does the rest. It is a simple, easy-to-use app. If I can understand it, anybody can. And it helps you dollar cost average, which is important in my opinion. when you're dealing with an asset as volatile as Bitcoin. Now, I've said before, there is risk with Bitcoin. I do not want to downplay that. But I have vetted the team over at Swan and a lot of honest people. My friend James Lavish, actually, I think is an advisor to Swan, the gentleman we'll be talking to today. So maybe I'll have to ask him about that. But I know Lynn Alden is involved over there, and Larry Lepard is also too. So as far as Bitcoin goes, I feel a lot of confidence putting the name Swan on my podcast, more so than I would, I don't know, like FTX or Celsius or some company that's promising you 10% yield on your Bitcoin or some other bullshit. None of that. It's a simple, easy-to-use app that helps you stack Bitcoin. End of story. For right now, they will let you stack $10,000 without fees. So your first 10 grand, they won't charge you any fees on. And if you use my link, swanbitcoin.com/QTR, it is in the podcast description if you would rather click on the old hyperlink rather than remember it. Use my link, you'll get $10 immediately in free Bitcoin. So I would do that unless you hate money, and then I wouldn't do it. So Swan Bitcoin, love you guys too. All right. This podcast is not financial advice. I'm not a financial advisor. I hold no licenses. I hold no registrations. I am in no way a financial professional. This is generally for informational purposes only. Please, you're trading and all that nonsense, you're doing it at your own risk. Make sure you speak to a financial advisor. I am not a financial advisor. I am not soliciting you to buy or sell any securities at all. Just having an open-minded discussion here for purposes of trying to figure out what the fuck is going on in the world. Please, any issues you have, talk to your personal financial advisor. Any other issues you have, speak to your personal therapist. I don't want to hear about those either. Take Tylenol for any headaches, Midol for any cramps. All right, let's get started. He writes the Informationist newsletter on Substack, one of my favorites. I have unapologetically stolen content from him in the past because he has a great way of putting things down that people can understand. And so I have Mr. James Lavish here. It took a long time, sir, to finally get you out here.
Chris, it's good to be here, and I appreciate you having me on. It has taken a long time, but you're a busy guy, so
well, actually, it was both of us. And usually, when I offer up the prestige of appearing on such a world-renowned, award-winning podcast, people jump at the opportunity. So imagine my surprise when I was given the cold shoulder, my friend.
Yeah, I'm aloof, so I like to keep it that way. But no, it's awesome to be here, and I'm glad to finally hook up. I love your newsletter as well, and so this is a great matchup.
There's varying degrees of ass kissing that I do with guests on the podcast, ranging from I'm generally interested and am intrigued to talk to somebody for the first time to I actually read their shit all the time. And you're on the far end of that spectrum because I actually do read your posts when they come to my inbox almost all the time. So awesome. What I was hoping we could do today is you could give my listeners just a little bit, and I've heard you do this before and it's fantastic, a little bit of a rundown on where the state of the nation is right now from a fiscal perspective, kind of what that means in general. So like a 101 for people that may not understand it completely. And then from there, we could talk a little bit about monetary policy and other things that people should be keeping an eye on.
Yeah, brilliant. Where is the state of the economy? I think you're watching two economies right now, right? And that's causing a lot of confusion out there. You hear the Fed talking about inflation. You hear the White House saying they've gotten inflation tackled. You hear businesses saying that they're struggling. You hear consumers saying that they're struggling. They can't stand the inflation, the prices. They can't keep up. But yet you see these numbers that are coming out that seem to be okay. They're conflicting. You're getting unemployment numbers that are conflicting with the actual job numbers. You're getting pricing that is conflicting. If you go to the grocery store, you're looking at the prices. You're saying there's no way this is up 3.2% from last year. This is up 10, 12, 15%. So there's confusion out there. So what is the confusion? Well, the confusion, Chris, is that you've got pockets of recession, which are natural when you have the Fed raise rates so quickly and hold them there for so long. And look, 5.5% is not incredibly high rate on interest rates on the Fed funds rate historically. But when you raise rates from just over 0% that they were holding for a decade to 5%, it's massive, because we've become incredibly indebted in this nation, which we're going to touch on quite a bit here. But the most important thing to understand is why so people are asking, well, if the Fed has raised rates so steeply, why is the inflation rate not come down? Why is it not down back to the 2% or under 2% target? And the answer is that it's because the government is spending wildly, so incredibly irresponsibly that it's causing what we're fiscal dominance, meaning fiscal spending is dominating the Fed's attempt to tackle inflation by raising rates. And so you're seeing pockets of recession, and people are feeling it. People are feeling it in their pocketbooks and their wallets. They're feeling it and their credit cards. They're feeling it when they go to the grocery store, their auto payments, their insurance payments. Everything has gone up. Yet you're seeing these numbers that are saying, yeah, but the economy's great, everybody's employed. And it's kind of it's confusing, and it's not really true. If you look at it as a whole, yeah, it looks okay. But if you dig in deeper and you do a little bit of critical thinking, which seems to be difficult for mainstream media these days, if you actually think about what they're telling you and look into the data, you see that they're either flat out lying, or they're just completely incompetent in creating the data, and they're incompetent at telling you the truth, or incapable of telling you the truth.
Yeah, no, you're absolutely right. And one of the other questions that I've been struggling with, maybe something you can talk about, is how 5.5% rates historically are not high, but really after what we've just endured over the last 15, 20 years. I mean, I feel like hiking rates to 5.5% as quickly as we did is nothing short of catastrophic, earthquake, earth-shattering, tectonic plate moving style move. So maybe if you can explain a little bit why, that's so important to look at relative to the past, but then also appease me a little bit and maybe touch on why it's taking so long for the seismic shocks that I'm expecting, at least, to make their way through the economy. Because it doesn't appear to be showing up in the economy. Sure as hell doesn't appear to be showing up in the stock market, right?
Right. So what's happening is it's that federal spending. It's the government spending so much money that you're seeing areas of deep recession. There's just no question about it that commercial real estate has a problem, and that means that regional banks have a problem. The Fed is all over this. The regional Fed reserve banks are all over this. They are working with these community banks to make sure that they don't go under, and we've already seen them go under. We saw Silicon Valley go under. That's a little bit of a different situation that didn't have to do with commercial real estate, but that had to do with exactly what you talked about. Right. So you have rates that rise catastrophically, on a meteoric pace. Right. So when you're a bank and you own treasuries and you hold those treasuries in your reserves, you are marking them as just mark to market if you must to show on your balance sheet. But the reality is, a lot of these banks just consider U.S. Treasuries to be riskless because in the last 15 years they were riskless. If you owned a Treasury, there was pretty much a certainty that the price of that Treasury would just gravitate to par, and you would mature, and you would get your maturity payment, and you would get all the coupons along the way. However, when you raise interest rates from 0.025% to 5.5% on a bond that's 30 years duration, that's raising that that you're basically saying that if you went to try to sell that treasury that you own, let's say that they own a 1.5% treasury, and it's a 30-year treasury, and it's yielding 1.5%. They go to try to sell that in the market. Well, that's a difference of 4% annually for that bond. So if this thing it still has 7, 8, 10 years or 15 years of duration on it, that means you're marking this bond down significantly. It's not just a few percent. You're marking it down 25, 30, 40%. And so what happened with Silicon Valley Bank is exactly that. They felt that crunch of interest rate risk where they did not hedge that interest rate risk. They were reckless. They actually manipulated their models to make it look better than it really did, and their risk models, they papered over it. They didn't sell. They didn't hedge their currency, their interest rate risk with their bonds. And so when customers started hearing about this, big customers, the technology companies or very wealthy people out in Northern California, they started hearing about this. They got nervous and they thought, oh God, they really don't have the money to pay us. If there was a run on the bank, they only have 60, 70 cents on the dollar to pay people. So I'm going to get my money out first. And so they had a plain old fashioned run on the bank. And so that's one way that this can manifest itself. And you saw that happen. Well, what did the Fed do? They stepped in, they teamed up with the Treasury, and they created a new acronym, the BTFP, the Bank Term Funding Program. And that basically said, okay, if you're a bank and you hold treasuries, don't worry about marking them to market or having to sell them in the market. You can put them to us and borrow against them at par. So don't worry, that eliminated the interest rate risk they had at that point. So any bank that needed to shore up its reserves and capital base could just go ahead and borrow at par. It basically just eliminated that market move, which was created by that rise in interest rates. So there's one way that they kind of papered it over. They didn't let anybody fail. They didn't let these irresponsible banks go under. And so by doing that, you skirt the possibility of a recession right there, driven by fiscal or driven by fundamental irresponsibility at banks. That's one way. And then you start thinking about commercial real estate. Well, commercial real estate that has a whole new dimension to it, because we suddenly had, after the COVID lockdowns, we suddenly have work from home policies where many of these businesses are not fully staffed in their offices anymore. So instead of re-signing leases, they're either not signing them at all, or they're signing them for a lower amount of square feet. And so it's leaving these office buildings 20, 30, 40, 50% unoccupied. And so that basically says that the cash flow of that building is so low that it cannot sustain the mortgage on it. So what's happening? Well, you've got the Blackstones of the world, the very large funds, investment funds, they own these buildings, but they own them through a non-recourse loan. So they just turn around and say, you know what? We're going to take the loss on our equity in it because it's so far underwater that if we tried to sell this building, we would only be able to get 30 or 40 cents on the dollar for it. So we're just going to go ahead and turn over the keys to you, the bank, and you now have an impaired asset. So that is going on across the nation right now. And so that is a problem. However, it's not in all commercial real estate. It's really focused on that office sector, the office building sector. And so, but there's still trillions of dollars of office real estate that's out there that is impaired. And so that's a problem. And that's something that the Fed is focused on. They're working with these banks on to make sure that they don't go under, because guess who owns most of this commercial real estate? Who has put out the note on it? It's those regional banks. It's the community banks, and so they don't have the balance sheets to sustain this, and that is a problem out there, and it's looming. Will it turn into a crisis like the Great Financial Crisis? I don't think so, but it is something that they're aware of, and they're trying to maneuver around.
So where do the consequences wind up? I mean, in a situation like this where we all know what the Fed's game plan is, they're going to take any blips in the market, any speed bumps, and try to smooth them out by any means necessary, and they're going to bail out anybody that they need to prevent the market from going down or to prevent any type of discomfort, really. We've become addicted to being 100% comfortable all day, every day. But, most people know, even if they don't understand the inner workings of it, that all they're doing is kicking the can down the road, and that they're taking, they're taking consequences from one place, the regional banking sector, and they're moving them. So how do those, where does that manifest now? Does it manifest on the Fed's balance sheet? Does it manifest in more inflation? We always pay for it somewhere, right? We pay for it through inflation and taxation usually. Where do we pay for the bailout of the regional banks and commercial real estate?
Well, let's back up. So, why is it so important for the Fed and the Treasury to not allow the markets to crash? Well, a significant portion of the federal tax receipts come from stocks, that come from those assets. So they can't let the stock market crash because people. The economy is driven by this, and it's been shown for the last decade that the stock market really is a large part of the economy. And it's not just because of tax receipts off of capital gains, but it's because people look at their net worth and they see their net worth go up in their stocks, and they're willing to spend more money, more of their discretionary income rather than saving it, because they think, oh, well, look at my net worth is up 20, 30, 40% in the last couple of years. I'm fine. I'm going to go ahead and spend my paycheck. I'm not going to put any more money into the market. I'm good. And so it just drives that economy. It keeps it going. So they can't have that fall off, right? So, but and then of course, if the stock market crashed, it could be catastrophic. Why would it be catastrophic? Well, it's exactly what you were pointing to, which is the fact that we are so indebted and we're so addicted to this stimulus. The reason for that is that we are indebted all the way up to the federal level. So if you go back, it really started back in 1998 with long-term capital management. You remember this, right? So when long-term capital management, I was an arbitrage trader at a hedge fund in Dallas. Actually, we were sitting in Fort Worth at the time, 1998, and what happened was you had this hedge fund that was levered up over 100 to 1, and they had all these swap lines, and they had derivatives and paper out all over the street, and so the issue here is that they had about $1 billion of capital in their AUM, right? So, but the thing was they were taking about $100 billion worth of positions. Yeah. And so that doesn't sound like a lot of money today, but back in 1998, that was a lot of money.
Doesn't matter if it's 100 times your AUM, whether it's a penny to $1 or $1 to 100, it's a lot.
Right. And so these geniuses who, and this is Myron Scholes and Robert Merton, who were, back Scholes, the Black Scholes model. These geniuses went out and shorted. They were basically shorting volatility in their interest rate arbitrage trades. But, what happened was, and
15 years too early, huh?
Exactly. This is important. But what happened was, they were, when the Russian ruble was devalued, the spreads blew out. They had positions that blew out, and the street caught wind of it, and they were about to go under. And if they went under, it was going to take Goldman Sachs under. Okay, so why is this significant? Well, this is significant because the Goldman Sachs CEO walked into the New York Fed and said, if you don't rescue us, we're toast. We're going to go under tomorrow, and we're going to take down probably a dozen banks with us. Okay, so the Fed, then they orchestrate a bailout from other banks to make sure that Goldman doesn't go under in that boardroom. And so this is the first time that we really had a bailout. I mean, you heard Greenspan say it back in 1987. He was like, don't worry, we've got your back, and that kind of shored up the confidence in the market. Flash forward just 11 years, long-term capital management takes unreasonable risk, and they blow up, and they're rescued. Goldman Sachs is rescued. March on. 2000, 2001, we have the tech bubble, and that's kind of kicked up to the banks. Okay, march on. And then we continue on, and we've got this risk and this debt indebtedness that's now kicked up to the banks, and now we're coming on the great financial crisis with the housing market and the housing bubble, and all of these banks who are holding this mortgage paper, which was just garbage. They end up going under. Where does it get kicked? It gets kicked up to the federal level, and so now it's sitting in the Federal Reserves on the Fed's balance sheet. And so then flash forward to 2020, and you've got the lockdowns that caused the entire economy to grind to a halt, and the government, in a panic, went and monetized $6 trillion of debt. And so you've got a Fed balance sheet that's holding more treasuries than anybody else in the world. And so what's going on today is that the problem is we have a fiscal policy that is absolutely unimaginably irresponsible. And so we're running $2 trillion deficits at a time that we're not even in a recession. So all this matters because the indebtedness and the risk has been kicked all the way up to the sovereign level. And so the punchline is that if you have a collapse of the economy, it's the sovereign level that must stomach it completely now. So, we can walk through the numbers, but the bottom line is that the U.S. government has entered, and in the Treasury, because of this, has entered a debt spiral. We now have $34.7 trillion of debt, which is over 120% of GDP. And basically, if you're a country of over 120% GDP, your fiat currency fails.
Right.
And so this is where we're at. And we're just spending and spending and spending and spending and spending. And what happens if you get into a recession? Well, your tax revenues drop precipitously, and your spending rises at a similar rate because of all of your programs, your social programs like unemployment and wage security. And so you wind up having a deficit that's not $2 trillion, but it could be $3, $4, $5, $6 trillion if it gets bad enough. And so just imagine that we are adding over 10% to our debt in a year, maybe 20% in a year. So that is the debt spiral. We can't do that because the rest of the world will turn around and look at our bonds and say, why would I buy those bonds if they have to just keep issuing new bonds to pay me for my bond? That means that they're going to have to, we are in a situation where we have to just continually issue more and more and more debt. And this is rising exponentially. And there really is no way out. And that's the problem. And so your MMTers, your modern monetary theory proponents think, well, it's just, you're just driving the economy. There's no big deal. However, when the music stops and people stop having confidence in the U.S. Treasury because of the problem with it feeds into the U.S. dollar, that's when you get into a problem. Well, why does that happen? It happens because of inflation. So it all goes back to this central problem is this constant and relentless manipulation of the monetary system through central banks that create inflation that is a soft default on that debt every single day, because the dollars that you're getting paid back in the future are worth less than when you lent them out to the government in the first hand. So who wants to lend the U.S. Treasury dollars for 30 years when they know that inflation only has to go up in order to continue this charade?
Yeah, and the alarming thing is we're not even telegraphing. I mean, forget about cutting spending, which would be, I don't even know if that would be pissing into the wind at this point. But I mean, certainly if we wanted to actually try to implement some type of solution, that would be a large part of it, we would have to, cut our spending. We're not even telegraphing doing that. We're not even talking about it. It's not even a thought. It's not even on the table. And you know how these wheels turn. We need to talk about it, and then 5 years later it happens. And so the idea that we haven't even acknowledged what you're talking about makes this even more frightening, doesn't it?
Oh, I mean, we don't have a debt ceiling right now. We paused the debt ceiling. There's no limit to the amount of debt that we can put on this balance sheet now. So, let's, for the benefit of people listening, let's walk through some numbers so they can actually bite into something. Okay, so yesterday the CBO updated their projections for the year for 2024. Who's the CBO? It's the Congressional Budget Office. They look at what Congress is doing, and they budget out and see where we're at, and to give everybody an idea. It's to give Congress an idea of where they are, and it's to give the Treasury an idea of where we're going, and so everybody can plan out. So what do we know? Well, we know that GDP is expected to be about $28.5 trillion this year. Okay, so off of that, this is where the government makes their money. I mean, it's not really revenue to them. It's really just taxing our productivity. That's another conversation, but because the government isn't really productive at all. They just waste money left and right. They're not really doing anything. So, but they are expected to take in $4.9 trillion of taxes this year. Okay, well, how much are we expected to spend? $6.9 trillion. And there's your $2 trillion deficit, which is 7% of GDP. Just remember that. That's a large number. So the problem here, though, is that, okay, everybody says, well, you can just keep running deficits. You can keep, adding to the debt. But here's the issue. And this is going to go into what you're talking about with your choices, cutting spending, whatever you're going to do. And let's walk through those. But first of all, if the United States was a company on the New York Stock Exchange, it would be considered a zombie company. And what do I mean by that? What I mean is the country, this company, the U.S. government, does not take in enough taxes to cover its mandatory expenses. Okay, so that is a massive problem. It's basically saying you can't cover the interest on your debt, which means that you have to issue more debt in order to pay that interest.
It's the opposite of being a profitable company. It's the opposite
Correct.
of, saving money at home. It's the opposite. It's one thing I always talk about on my podcast is it's stunning how these natural laws of economics work at home. They work at your municipality, at the state level, on the corporate level, but then all of a sudden you go to the sovereign level and it's a whole different set of rules. Sorry, continue.
Completely. Yeah, it's a completely different set of rules. So remember, we said that we spend a total of 6.9 and we take in 4.9. Now let's back that up a bit. Your mandatory expenses, what are those? These are expenses that are signed into legislation. They must be paid. We're talking about Social Security, Medicare, Medicaid, and other programs that are signed into legislation. They must be paid. This is $4.1 trillion. Remember, our tax revenues are 4.9. So that's 4.1 gone out the door. That has to be paid. Then you have your defense spending, which has gone from 800 to 950 billion this year. 950 billion that we know of. That's 950 billion that's going out the door. Now you're over 5 trillion. Then you add in your net interest expense. This is the expense that we're the amount we're paying on interest on the debt. That $34.7 trillion of debt is over $1.1 trillion. Now there are intergovernment debt obligations, so that the net interest that the Treasury is actually paying is $900 billion. You add all that up, 4.1 plus 900 plus 950, you're at $6 trillion right there. $6 trillion on $4.9 trillion of tax revenues. It doesn't take a genius to see that this isn't working. And then you add in your discretionary expenses, which are about $900 billion, and that gets you your deficit of $2 trillion. Okay, so that's just part of the picture, though. That's just part of the picture. You add in the rest of the unfunded liabilities. These are all the liabilities out there in the future that they have to pay. I'm Gen X. I'm expecting to get paid something for all of the money I paid into Social Security, Medicare, Medicaid, all these years. I've been paying in a percentage of my income every single year. Well, you add all that up for the rest of the boomers that have not that are still alive, that are retired, that are getting their retirement, their Social Security, they're getting their Medicare and Medicaid. You've got Gen X, you've got all the other generations. You add all that up, and it's $217 trillion of unfunded liabilities. That's a total of $250 trillion of debt and liability for the U.S. government. So just to these numbers are so mind-boggling. If you have $250 trillion of debt and liability on what we're talking about, GDP of $28.5 trillion, if you just put that in terms of a household, that's like somebody with a $100,000 salary with $5.1 million of debt.
Yeah, it's just unfathomable, right?
It's unfathomable. This is a train that will not be stopped. It cannot stop. So what are your choices? Your choices are you can cut spending, which is what you're talking about, right? So you can cut some entitlements like Gen X. Sorry, you get 60 cents on the dollar for your all of your paid in Social Security, Medicare, Medicaid. You're going to get 60 cents on the dollar. Sorry, you're not secured, which is absolutely political suicide. You're going to cut spending of your constituents. You're going to cut spending on programs, the green programs, or the whatever. It's political suicide. Neither party will do it.
Neither party's capable. I mean, everybody is so cowardly and dickless in politics. It's just that we're not even close to thinking about it, let alone doing it.
They think in 2 and 4 year terms. That's all they care about. They don't care about anything.
Not even. 6 months and 2 week terms would be probably better.
Because they cannot for a moment be unliked by their constituents. They have to be reelected. So they try to trick each other into it. You see it every single political cycle with the debt and the debt ceiling, and whether either party will be tricked into cutting spending in some area that will hurt them politically. Neither party does it. You look at the debt ceiling; it's raised every couple of years. It never stops. Okay, so that's one thing you can do. It's not going to happen. Spending is not going to be cut. The second thing you could do is that which is called austerity. You saw Greece being forced into it, but they were strong-armed into it by the EU. Nobody's going to strong-arm the U.S. into cutting spending. So the second thing you could do is you could raise taxes. Yeah, tax the rich, tax everybody who's making all the money. Okay, that sounds very interesting to people who don't have a lot of income, but the reality is that when you talk about taxing the rich, you're really talking about taxing small businesses quite often, and large businesses that are quite productive in the economy.
And job
so you're
creators.
Talking about job creators. So what happens when you raise taxes? Well, you end up cutting investment into research and development, in investment into productive business lines, expansion of business lines, expansion into new business lines, and so that you're taking away jobs, you're taking away productivity. So you wind up having higher taxes on lower productivity, and you get to the same spot. It doesn't work. So, and it's actually even worse because now you've got declining productivity instead of increasing productivity. It doesn't work, and we're seeing it play out in various regions of the developed world, especially in Europe. It's not working.
It gets worse.
That's the second
It gets worse the further you go along, which is like why it's called a debt spiral, right? Like it just once the snowball starts rolling down the hill. It's underway. I'm sorry, I cut you off. Yeah. No, I cut you off.
Yeah. But those are your two options. Your third option is to issue more debt, which is what we've been doing. Just borrow more, borrow more, borrow more. So this is like the single parent who has their mandatory expenses. Okay, so there's a single parent. They're working a few jobs. 2 or 3 jobs are just trying to make ends meet. They can't keep up with inflation. They're just trying and trying and trying. So what do? Well, they take out a credit card because they have to pay for food for the family. They got to make sure they pay for their mortgage. They got to pay for their car. They got to put clothes on their kids' back. So they take out that credit card and they turn around, and next thing you know, that credit card is run up, and they got to take out another credit card to pay down that credit card. And then they got to take out another credit card. They get into what's called a debt spiral. They can't get out of it. And this is where we are. So what is the option for the U.S. government? If they continue to borrow, what does that mean? Well, that means that they there absolutely is no way around it. They must have inflation. That inflation allows that GDP to grow nominally. Remember that $28.5 trillion number? That has to go up. Nominally, meaning just in terms of dollars, not of inflation adjusted. So when you have more dollars in the system, it creates more GDP because there's more dollars. And so that GDP number goes up, the productivity number goes up, but it's fake. It's not more stuff. It's just stuff that's more expensive. So there's more dollars in the system. And so when you go to pay down that debt in the future, you're paying it down with dollars that are cheaper, right, that are worth less. So this is called the debasement of the US dollar. So the US dollar gets worth less and less and less and less every single year. And so this is the challenge. The US government absolutely must have negative real rates. What do I mean by that? That means they must have coupons on their treasuries that are lower than the inflation rate. And they have to have this in perpetuity. And that's the only way they can keep this charade going. It won't go on forever. Make no mistake, this cannot go on forever. But what will happen is that we will see periods of high inflation in order for this to just keep going. And that's the problem. That's the issue.
So you think a round trip back to negative rates is a foregone conclusion? I mean, if
momentary at best.
If the option is that or any type of discomfort, I know that that's what it's going to be. Right. But I mean, you're talking about really the dying embers at that point of the country from a financial standpoint, from an economic standpoint. I mean, how much time do you see before we wind up in those negative rates, and then how long do you think it takes before the whole thing just goes bust? Because we're out of options after that, is what you're saying, to kick the can down the road?
Yeah, I don't think we can get to negative rates. If we get to negative rates, we're going to have to turn around and print so much money, it's going to make your eyes bleed. You know, I mean, think about it. The last time we did this and we got into negative rates because of the pandemic, we had to print trillions and trillions and trillions of dollars. We're not going to print $4, $5, $6 trillion this time. We're going to print 10, 12, 15, 20 because the system needs it. The U.S. government is borrowing over $2 trillion a year now. And we cannot have a system that collapses. So what this all comes down to is, look, we have a lot of fancy talk that comes out of the Fed and that comes out of the Treasury, and some of it's confusing. The Fed talks about having two mandates. They have their dual mandate is stable pricing, and when asked about this, what the response is that means 2% inflation. When asked about that, when asked about that, just about 8 weeks or 10 weeks ago, Powell was asked about this on 60 Minutes. Why 2% inflation? Right. And he proceeded to give a 90-second word salad answer that meant absolutely nothing except because it's the way it's always been done. It's what we can get away with. Right. And that's really what it comes down to, is that people can get away with. Yeah, people don't revolt when their ice cube melts by 2% a year. They'll revolt if it's melting by 10, 12, 15% a year. And we saw this happen in the 1970s. I mean, I grew up in the 70s, and this was absolutely awful. You had a period of stagflation where we were not expanding in the economy, but we had high inflation. Well, when you flash forward to today, I mean, you can't have what happened back then is that Volcker raised rates up to 18, 20% in order to battle this inflation. We're not going to do that. We can't do that now. Can you imagine if we raised rates on up to 15, 20% on 30, you've got $35 trillion of debt, $2 trillion and adding to it every single year. Can you imagine spending 20% on $2 trillion? That's adding in 20%. You're adding another $400 billion of interest to your expense, which is already which is a trillion. You're going to add 50% of your interest expense in a year? It's not going to happen. So what they'll do is they'll allow inflation to run a little bit hot, but they're trying to keep it in check because why? Let's go back to the dual mandate. The dual mandate is stable pricing, 2% inflation, and full employment. Okay, so when you pull back that onion and you get to the core of it, like, what are we talking about? Why 2% inflation, stable employment? Is it because they love the Americans so much? Is that why they're doing this? Because they're so concerned about us and make sure that we are thriving and we're in a good economy? No, it's because they have to instill confidence in the U.S. dollar. That's the whole point of it. When you get to the first principle of it, instill confidence in the U.S. dollar. Why? Because the Treasury must borrow more. Why? Because the government will not stop spending. Why? Because that's their incentive. Their incentive is to spend to get reelected. That's what it comes down to.
And is it accurate to say that the quicker the rest of the world calls us on, treasuries being worthless and the dollar being worthless, the quicker all of this will unfold?
Sure,
because I'm thinking about what we're seeing with BRICS right now and how it's kind of unprecedented, and how to me it feels very obviously like a challenge to the U.S. dollar as a result of weaponizing the dollar post Ukraine-Russia conflict, even though there was de-dollarization going on with Russia and China prior to that. I mean, how much is that playing into things?
Well, I mean, let's talk about that, because that was a catastrophic mistake in my mind. And when the U.S. government froze treasuries and they froze the Russian assets and basically seized them, took them off the SWIFT lines, which is
now
the
they're redeploying them to Ukraine.
Right, even worse. And so, what did that signal? That signaled if you are not an ally of the United States, then you should not own treasuries, because we will freeze and take them from you if you step out of line.
Right.
Okay, so that's a problem. So you're seeing China kind of wean themselves off. So the BRICS itself, like, we hear a lot about the BRICS. Let's get it back. Let's go to a little bit of reality here. Let's have a reality check. Like, you're talking about Brazil, Russia, India, China, South Africa. These are not nations and areas that have leadership that can be trusted. Let's just put that out there. That's the reality. Are they going to trust each other? No. So how are they going to actually have a central bank currency amongst them? Well, they probably won't, at least not anytime soon. But what they can do is come up with agreements to pay for energy in something other than the U.S. dollar. And that's the point of it. And that's the problem. Why is that a problem? That's a problem because if they don't need U.S. dollars, that means they don't need access to U.S. dollars. Now, this is getting way ahead. This is not a reality today. They all still need dollars. That's just so much of the world commerce that happens in U.S. dollars. It's just reality. The dollar's in this wonderful position of being the world reserve currency, and that makes the treasury the world reserve asset. But they need those treasuries so they can have access to dollars pretty quickly, because they just sell treasury, get dollar. Right? So the issue here is that they're all trying to find ways to do business without the U.S. dollar, so they don't have to hold the U.S. treasury. Why are they doing that? Because they see what's happening. They know that we're running multi-trillion-dollar deficits in a time of peace here in the United States, where we're never in peace across the world, but we don't have a major recession going on. We're running massive deficits of over 7%. That's just mind-boggling. So this matters because countries are seeking ways, especially non-allies, are seeking ways to do business without having to hold treasuries. And I just saw a chart that the international demand for treasuries is pretty much flatlined, while the demand for issuance of treasuries has gone parabolic. That is a problem. Have those roosters come home? Have those chickens come home to roost yet? The answer is no, they have not yet. But will they in the future? Absolutely. Is that something that's going to happen very soon in the next 3 to 5 years? I personally don't think so. And it's because people around the world, if you still go to these economies that are struggling, if you go to places like Argentina, Venezuela, Lebanon, Egypt, they all want to get their hands on dollars. Very difficult to do. It's not easy. Dollars are expensive, but they all want dollars. Why? Because their currencies can't be trusted. Their own currencies can't be trusted to not be inflated away.
Right.
They still want dollars. As bad as a dollar is, it's only, somewhere between 5 and 15% of inflation a year. We're not talking about 70, 80, 90, 100% inflation. Like these areas are suffering from catastrophic inflation when you talk about being able to save what you earn. So it's just so the dollar is so deeply embedded in the world system, and we don't even know how much debt is out there really dollar denominated because of the euro dollar debt. And so when you have dollar denominated debt around the world, it's difficult to know how much demand there really is. But it is problematic, and there are major countries that are, and these are superpowers now, that are seeking to wean themselves off dollars, and that is an ominous sign for the U.S. Treasury.
Do you feel like the market is going to lock up here at some point? I mean, I know that you're saying there's a vested interest in making sure that it doesn't, and I understand the reasoning behind that as you explained it. But I also feel like the Fed is a reactionary entity. They're not proactive, they're reactive, and every time they've taken drastic measures, it has been usually late and usually as a reaction. And so I just am kind of wondering what's going to shake the shit out of them so much that they realize we can't stay at 5.5% rates. Because right now the jawboning at least is like, hey, we can stay here, nothing's really breaking. Like, sure, a little water starting to kind of like drip through the dam here a little bit, but nothing is fucked. Nothing is completely fucked here, dude. But like at some point, something is going to be fucked. And so, do you feel like that's going to be a stock market lockup? Do you feel like it's going to be economic data? Do you feel like it's going to be another bank revealing, hey, we just took a mark on X and X asset that is going to force us to, make a fire sale like Silicon Valley Bank did? I mean, what do you think? What will be that catalyst?
Yeah, so if you asked me this question early last year, I would have said absolutely, and I did say absolutely. There's going to be some sort of credit event. You can't raise rates the way they did without something breaking somewhere. And what I mean by that, what's going to break? Well, it's what we were talking about with Silicon Valley Bank or some commercial real estate indebtedness that causes toppling of a large enough bank that causes what we call contagion, where that collapse causes another collapse like dominoes. And so I would have said that, but the reality is the federal government is spending so much money that they're papering over this, and they're creating jobs. They're hiring like mad, and they've hired millions of people back into the force in the last few years. And so the issue here is that it's fiscal dominance is really creating a situation where it's not even a soft landing. We never really even landed. It's just creating more and more stimulus, which is basically more printing, more money printing. When you are running $1 trillion deficits, that's inflationary. And so what they can't have is asset prices collapse, and which is what we just talked about. Okay, so what happens? Well, I do still think there is a risk. It's much higher than non-zero, that something does occur that we are not expecting, some sort of black swan. And that's why they call them black swans. I mean, I would say that something like the Great Financial Crisis wasn't really a black swan because everybody had been talking about it for months, but the banks and the regulators ignored it. This would be something that is just absolutely outside of the realm of people's ability to expect or predict. And if that does happen, then what is the danger? Well, the danger is that you have the Treasury market lock up, meaning that it goes no bid for the Treasuries. And if that happens, well, that it can't happen. Like, that literally cannot happen, or the whole system falls apart. So the Fed will turn around and monetize the debt again. So what you would see is a sharp sell-off in the markets, in all assets. Basically all assets will correlate to one. We saw it back in March before April of 2020, when all assets just sold off. Well, why does that happen? Well, what happens is you get this event, everybody gets nervous, they start selling. And so you have portfolio managers that walk onto their floor. And I've seen this happen. I've been witness to it, where you walk onto the floor, you see markets in absolute disarray. There's just they're basically bodies everywhere, and there's nowhere to hide. And so you look at your portfolio, and are you going to sit there and try to figure out, what should sell off, what's worth more, what's worth less? Oh no, all you know is that you're about to get margin calls on something. So you need to raise cash.
Right.
So you just turn around, you tell your traders, you say, sell 10% of everything.
Right.
Don't even blink. Just sell 10% of everything. I want 10% off the books. I need capital. And it doesn't matter if it's Nvidia, it doesn't matter if it's Apple, it doesn't matter if it's Berkshire Hathaway, or if it's gold. They're selling it. And everything correlates to one, meaning that everything goes down together. And so when that happens, we're also talking about U.S. Treasuries. So it's not like if you're an institution, you need cash, you're not going to sit there on your 30-year bonds. You're going to be selling those too. Everything gets sold. So when that occurs, everything draws down, and then the Fed steps in just like they did in April of 2020, and they monetize debt. They buy treasuries. They buy mortgage-backed securities, and what they're doing is they're printing money. The treasuries basically, it's more or less the Fed presses a button and puts reserves on the balance sheets of these banks to go into the market and buy treasuries for them. And it's a capital that wasn't there before. It's an expansion of the money supply, and it's inflationary. So they flood the market with liquidity. They buy up the treasuries and the mortgage backs. It stabilizes all of the markets. People come rushing back in, and everything recovers like a V. And so you have a sharp downturn and you have a sharp recovery. I do not expect a long, drawn out market malaise of 5-10 years of the stock market down 20, 30, 40, 50%. I don't expect that, because I don't think that it can truly happen without seeing the cracks at the sovereign level widen enough for that to be catastrophic.
Okay, so given that expected scenario, and let's say that plays out over the next 5 years, just as you described it, what would you expect CPI to do?
I would expect CPI to go up in the, we saw it go up to 9%. I would expect it to go up to 12, 15%. That they admit to.
Yeah, I was going to say, and also, would you expect the government, pretty much this whole time to be doing everything they can to rejigger definitions and hedonic adjustments, et cetera, to try to put as good of a spin as possible on all macro numbers, not just CPI?
100%. If I were them, I would, and I, my incentives were the same, I would probably do the same. But I'm not. My incentives are to help people realize what the hell is going on. And so, but the reality is that yes, they will come up with acronyms. They'll come up with backdoor liquidity programs. They'll come up with new definitions and new ways to slice and dice things. Like, look, when right now, and Luke Groman, he was looking at some stuff, and he realized that, there's a program right now that's being that they just had comments on about Freddie Mac guaranteeing second mortgages, and nobody's talking about it. And Luke brought it up, and in a conversation we were having, it was like, wow, that's actually pretty incredible if you think about it. Well, what are they talking about? They're talking about guaranteeing second mortgages. That means that banks will be incentivized to give people second mortgages. Well, why do you take out second mortgages? For personal liquidity, to pay down credit cards, to go on vacations, to put in a new pool or remodel, paint your house, whatever. you're taking capital out of this asset that's kind of illiquid. That's injecting liquidity into the markets.
Sure.
Right. So that's one thing. They're also talking about the ISDA changes. I wrote all about it in one of my newsletters. ISDA, the International Swaps and Derivatives Association, is basically it's the body that oversees the swaps and derivatives of the world in order to make sure that it's stable. Well, the ISDA, that association wrote a letter to the Fed, basically telling them, the Fed and the Treasury, saying, and other government bodies, regulatory bodies, saying, we think that you should remove U.S. Treasuries from the calculation of risk. So the risk calculations, and you remove them from the risk calculations, so they don't have to be included when banks look at their balance sheet and add up all of their exposures. Treasuries are not included, which basically means that they can buy unlimited treasuries.
Yeah, it's wild.
So why would they do that? Well, they would do that to allow the banks to have just unlimited liquidity, and for the Treasury to have additional liquidity, because now the banks don't have to they doesn't constrain the banks from buying treasuries. They can buy more and more and more. It's not going to hurt their risk measures. So then, this is something that this is the leverage ratios is what they're talking about. Like, how much leverage do they have on those banks? Well, what is that? That's additional liquidity into the system. The last Fed meeting, not this one, the Fed Powell announced that the Fed is slowing QT, quantitative tightening. What is quantitative tightening? It's when they take those treasuries and mortgage backs that they bought during the financial crisis and during the COVID lockdowns that they bought and put on their balance sheet. They're trying to get them off the balance sheet by selling them into the market. Well, they've been operating at about $60 billion a month, trying to bleed this thing off, either selling them or letting them mature. Well, now they're talking about backing that up, and they're just started this month. It's not going to be $60 billion now. It's going to be less than half of that. It's going to be $25 billion per month. So that's another way that they're not constraining liquidity. So remember, the interest rates go up. That's one way that they can constrain liquidity. The second way they can do it is by instituting QT, which is removing dollars from the market, removing liquidity by selling those treasuries that are sitting on their balance sheet into the market. So the dollars go back to the Fed instead of being in the market, right? So it's like them issuing treasuries. But the problem here is that they're competing with the Treasury. As the Treasury needs more and more and more liquidity themselves, they're like, well, we can't issue $60 billion a month when the Treasury needs $100 billion a month, $150 billion a month. We can't be competing with them. We've got to stop that. That's another way that they're providing liquidity. Yet another way they're providing liquidity is the U.S. Treasury has now instituted a buyback program. You may have seen this in the last announcement, the quarterly refunding announcement. They talked about how they are starting this new program where they're buying something that's called off-the-run treasuries. Well, what are off-the-run treasuries? Well, back in the day, back when you walked onto these bond desks before Bloomberg, and when we only had Quotrons as little green screens with dot matrix, basically, the bond traders didn't have access to electronic pricing. So they had these runs, these sheets of bonds, and they were just like these. It was like a thick wad. Remember these dot matrix printers with the little holes down the side of the paper, and you had to rip them off. Well, they would just have these reams and reams and reams of papers, like stacks of them. I remember walking onto the Prudential bond desk once, and it was just covered in these stacks of papers. Like, what the hell is all this? And they were basically, they're all the bonds for that day. They were pricing of the bonds for the day. They got a new run every single day. And they would look at these bonds and they would say, okay, so if somebody wanted to sell them, they actually call them on a phone. There was no quick message. There was no Bloomberg. There was no, screen. They would actually call them on the phone. Hey, I need to sell this, this GE 10-year bond. I need to sell this. And they'd look it up. They go, okay, well, Well, on there is all the treasuries too. So the issue here, though, is that if that bond, if somebody called up and said, I need to sell this 1999 treasury, and they're like, 99, Jesus, it's 2024, and you bought this in 99, you want to sell it now? I have no idea what that is. Well, back in the day, it would be called off the run. It means it wasn't on their run. It wasn't on that list. Like, they couldn't look it up. They'd be like, I don't know, I'll give you this for it. And it was just illiquid. It never traded. So the Treasury is now talking about buying what's the equivalent of today off the run, which is a very illiquid issue that doesn't trade much. Well, why would they do that? Is it really QE? Are they injecting more liquidity into the system? Not really, but they're greasing the system to make sure that everything moves efficiently, that nobody is looking for liquidity in the treasury market, that they have liquidity, that the treasury market is always liquid. Why? Why are they worried about this? Why are they concerned about this? Well, if you go back just 2 meetings ago, and the Fed had their press conference, Powell talked about liquidity. He talked about treasury liquidity, and he mentioned it's not his oversight. He's not in control of it, but they do recognize levels. Well, why do they recognize levels of bank reserves? Right. So they were asked about bank reserves. Why do they recognize levels of bank reserves? Okay, we'll go back to 2019. In September of 2019, we had something that was called the repo crisis. What was the repo crisis? Well, the repo market is where if you have treasuries, you can go into the repo market. You can loan. You could basically take those treasuries and borrow U.S. dollars against them from somebody else in the repo market. So, say you could say, hey, J.P. Morgan, I've got $10 billion of treasuries here that I need $10 billion of cash. Okay, fine. Here, you can give me your $10 billion of treasuries. I'll give you $10 billion of cash. Great, everything's great. Well, back in 2019, the repo market got dysfunctional. Why did it get dysfunctional? Well, there weren't enough dollars around. Why were there not enough dollars around? Well, because the Treasury decided to raise their funding, meaning they were trying to fill their coffers and issue more treasuries. At the same time that, this is in September of 2019, at the same time that corporations were trying to make tax payments, at the same time that international demand had pulled back because of currency fluctuations. And so back in September of 2019, the repo rate spiked. And so you could not find liquidity for treasuries. So what happened? Well, then the treasury market itself became a little bit dysfunctional, and they were very concerned about treasury auctions. So what do? They rush in and institute QE. They start buying treasuries themselves. This is 2019 fall, before the COVID lockdowns.
Right.
Nope. That people don't talk about. This was a major problem.
Yeah, nobody talks about this.
So the Treasury gets really nervous when bank reserves fall to 10% of total GDP. Well, total GDP right now is $28.5 trillion. So when bank reserves and they kind of kick out a number of 2.5 to 2.7 trillion, they're starting to get nervous that bank reserves fall below that. Okay, so they're keeping an eye on that, and so at the same time they're also keeping their eye on the reverse repo market. Why are they keeping an eye on the reverse repo market? Because when the reverse repo market, which is there's too much dollar liquidity out there. There's so many dollars out there that the banks are turning around. They're loaning dollars. They're basically buying overnight treasuries with these dollars and getting an interest rate on that because there's too much liquidity. Right now, there's just under $400 billion in that facility. We got up to 2.6 trillion during the lockdowns when we had all the liquidity. The Fed flooded the market with liquidity, and there was so much dollar liquidity out there that the banks were sitting on massive cash piles, and so they turn around. They're buying treasuries with it. They're getting paid 5%, an overnight rate to sit on US dollars. And great, awesome, we'll do that all day, every day. So basically, they're running out though. This is money market funds. This is when you're at Fidelity and you have your money in cash and they say they put it in a money market fund. Well, they're basically putting it in there's a significant portion of that is buying reverse repo. Some of it's T-bills, some of it's reverse repo. And so that's what we're talking about, dollar liquidity. Okay. So to bring this home, bring it all full circle, when that's completely drained, that means that we go back into the repo side where there's no dollar liquidity, but there's excess treasuries. And so when banks and hedge funds and financial institutions need liquidity, they have to go and find that liquidity by using the repo market. So what the Fed is watching is, okay, when the reverse repo is drained, that's it. There's no more excess dollars out there. And then when those bank reserves get down to $2.7 trillion, now we're getting nervous. Now we're getting nervous that we're going to have another repo moment like we did back in 2019. Does that make sense?
Yeah, and what would be the sign, like what would be the top sign to watch for? Even maybe just if you're just watching daily treasury auctions as well, like what's one or two things you would look for to that would precede that?
Yeah, well, the treasury auctions have been interesting because we've seen some pretty dismal auctions over the past number of months. Back in November, we had a terrible 30-year auction. Back in December, we had a terrible 20-year auction. Back in January, we had a terrible 10-year auction, or maybe it was February. I mean, you've seen pockets of bad auctions. What's a bad auction? Well, a bad auction is so basically you look at the auction and you hear tail. What is that? Well, when an auction tails, that means that the expectation of a rate is lower than the actual rate that the auction offers. Meaning that, remember, because these treasuries trade, when you have a treasury auction, they trade pre-market. It's like when issued. They trade before the actual auction.
You don't have to go through all the specifics because I'm going to link to the article that I put up in November 2023. It's called Treasury Auctions Explained for People with Short Attention Spans. And that article actually has in it your excellent read from 2023, basically
awesome.
Describing entirely how auctions work. So read that, and then we can continue with our discussion here. So just speak as if everybody has read that article. Again, it's called
Perfect.
Treasury Auctions Explained for People with Short Attention Spans, and it's on my Substack and on James's as well. Go ahead.
Awesome. So basically you're looking, is there a large tail? What's the bid to cover? Was there a good demand for it? But really what I'm watching very closely too is how much international demand was there and how much demand from the market was there. And so when you look at the lines and you see that they're basically what you have when an auction occurs, you've got your primary dealers. And your primary dealers are the ones who are facilitating the auction for the treasury. And so it's kind of like when you want to auction off a piece of art at Sotheby's. Well, Sotheby's is the one who's auctioning it off for you to the art dealers and to collectors. So I would say when you're looking at this, you're watching the primary dealer and you're seeing how much they had to take down. And it would be like, if you have an art auction and it doesn't go well, and if you're the treasury and you're the one who's selling this art and you turn around to the Sotheby's and you're like, okay, well, you have to buy 20% of this because you need to. And the primary dealer is on the hook for it. They have to. They don't have a choice. And that's what's happening here. So when you're watching these auctions, if the primary dealer is saddled with 17, 18, 20% of an auction, that's pretty dismal. Right. Because that means that there wasn't enough demand out there. They should, in a regular functioning market, they should be taking down 9, 10, 12% at most. But when they're taking down 18, 20, 22%, that's pretty telling that there's just not enough demand out there, at least not at the rate that the Treasury needs it to be. So they wind up saddling these primary dealers with it. And so, and the way those auctions work is people bid and companies bid for these auctions at a certain rate for how much they would be willing to pay. And then the Treasury figures out where it falls in. And if they push it all on the primary dealer, that's a bad sign. And then the other sign is the indirect bidders, which are basically your international buyers, central banks and international buyers. And so if that is very low, if that's below 60%, that's awful. That's absolutely awful. So, and that just shows foreign demand is dropping.
All right. I think that's a great place to stop, because that's a lot to digest. And also that, in addition to, well, it is. And in addition to, the bid to cover and looking at the size of these tails on some of these auctions, that's another great thing for people to look at. I think what I'd like to do is have you back on at some point relatively soon. And I'd like to kind of continue the discussion by talking about, personally how you see markets and, how do you personally invest? And what do you personally think are the best options in a situation like this? Because, people just listen to an hour and 15 minutes of everything is kind of screwed. And, I tend to agree with you. And so then the question becomes kind of, how do you swim upstream against the accepted wisdom and protect yourself? And I'd love it if you could come back on probably in a couple of weeks, and maybe we can continue the discussions. Does that sound all right?
That sounds great. I would love to. Absolutely anytime.
And how do people find your information other than jameslavish.com? How can they find your stuff in the interim if they want to connect with you and subscribe?
Yeah, so I'm on Twitter, just at James Lavish, and my Substack is at jameslavish.com. You can find it there. It's called The Informationist, and I take one subject, one financial subject that may be complicated, and simplify it for you every single week. And it's got, it's not as big as yours. It's got 37,000 subscribers.
Yeah, right
but
there. I'm at 40,000. It's the same, man.
All right.
And you'll be like George Gammon. Pretty soon I will be in the distant rear view mirror.
No, it's great. I love it. I started, a little over a year ago, and it's really done well. People love it. So I've got anyone from doctors, lawyers, firemen, truck drivers. I've got all kinds of people, and I just try to keep it simple for people so they can really understand. So, but those are big places. Yeah,
it's easy to understand, and that's why I like it. That's why I like
Awesome.
it. But again,
Awesome.
we're gonna have to have another discussion because I need to pick your brain on Bitcoin and on gold and on a couple other things. And so I'll look forward to having that chat in a couple of weeks. But glad we could kick things off, man. Really nice of you to take some time out of your day and come on, talk to my listeners. And I just want to let you know that I appreciate it. Hope we get to talk soon.
Absolutely. It was great to be here, Q, and I'm looking forward to it.
All right, James. Take care, buddy.
See ya.
That was the one, the only, Mr. James Lavish. Fantastic guy that understands exactly what the hell he's talking about, which is, something new if you're used to listening to me. All right, fools, I got a bunch of other great stuff coming up over the next month or so. Once again, I want to thank my sponsors, JM Bullion, George Gammon's Rebel Capitalist Pro, and my friends over at swanbitcoin.com/QTR. I'll be back soon. Peace.